Global stocks are up even though new data released Tuesday shows China's manufacturing sector continues to shrink. For more, let's go to James Hughes, the chief market analyst at GKFX in London. And James, investors shouldn't really be surprised about a declining manufacturing sector in China. I mean, this is all part of the economic transition they're going through, right?
Yeah, absolutely. And I think that's the case that we get at the moment. We have to look towards China, and any sort of negative news tends to still, to this day, move the markets in a particularly irrational fashion. Now, we shouldn't be surprised by that because, of course, these numbers aren't anything new, and they're not to be unexpected because we've seen the manufacturing data from China continue to fall recently. We've seen not just manufacturing data fall recently, but a whole host of different bits of data continue to be negative out of China. So the fact that the manufacturing is down, okay, it's not necessarily a good sign, but it's an expected sign that we've seen from China. It's the reaction in the markets which always, for some reason, tends to take us by surprise, and it shouldn't necessarily do that. But every time we see it, we do tend to get some kind of reaction.
And on Monday, we had China cut its reserve requirement ratio for its banks. Stocks reacted negatively, and then today, stocks are up, even though we have this weak data, as you suggest. What do you make of investors seem to be more encouraged by this rally in oil prices that we're seeing?
Yeah, it's almost which one is going to take the major headlines at the moment, because today we've been focused on China, the numbers from China overnight, and if you'd seen those Chinese bits of data and you'd seen the way the markets have reacted overnight, then you would be thinking that we'd have a negative start this morning. But of course, it's the oil price that moved back towards $34. But I think what's really helping the markets at the moment is almost a sense of stability within the oil markets. Okay, oil has moved higher, but we're still looking at this range between sort of $34 on the upside and around $26 on the downside. Now, although that is a $10 range, it's stopped the big falls, and that $30 level is really acting as a bit of a magnet for these markets. Anytime we go higher, it's really dragged back towards it, and lower the same thing. So I think that stability is the thing that's helping the markets. And when we see oil prices rally, we tend to see equity markets rally. But when the oil price is falling back towards that 30 or just below that $30 level, we're not getting such the big negative reaction that we were getting a couple of weeks ago or a couple of months ago or so. So to the downside, we've almost started to worry less about the oil price. Anything upside is really lifting markets. And I think that's a slightly more positive place to be in terms of this oil market route that we continue to see.
And James, you know, we started 2016 off to a really rough start amid worries about China and oil. Do you think the markets are sort of stronger 2 months later?
Yeah, I think there's definitely a feeling that we're over the worst of that. And I think what's interesting to note is that, and even Janet Yellen said this at her last, when she was testifying in front of Congress, was that she said, she used the words healthy correction. And of course, we have to remember that these markets from 2008, the crash in 2008, okay, we had the Eurozone crisis in the middle there, but really we've seen a strong recovery in this market. So I think the fact that a lot of people are calling this a healthy recovery, and the fact that the markets were due to dip back lower before pushing higher or maybe stagnating for a little bit, it's not necessarily such a bad thing. And we definitely can say now that the market's in a much healthier position. I think what will give us the real key idea as to where the markets are and what the true value is just how central banks start to react. Of course, we've got the ECB coming up, looking at more stimulus there, and we're looking at the Fed just to see if March they are going to act. We don't expect them to. It's just whether they act in March. If they don't, when are they going to act again? And that gives us the feeling of where we are overall when we paint the whole picture.
All right, James Hughes, the chief market analyst at GKFX in London. James, thanks for your time.
Thank you.
I'm Scott Gamm, and you're watching The Street.